Hello, and welcome back to another episode of Darwin Investors. Today, I'm here with Magic Mike, and what we're going to discuss today is about how to prepare for a market correction. We're going to look over the earnings calendars that the upcoming week and kind of come up with some suggestions about the types of stocks that might work in this sort of environment. How you doing today, Mike?
I'm doing well, doing well. Kind of excited to see what's going to happen tomorrow on the market.
I think we're gonna. I'm a permanent bull status, so I just think that we're gonna bounce back from this. Um, what does your investing look like lately? I haven't talked to you in a while.
Well, my investing has been to have a large cash position and to have areas that I believe will benefit uh, in companies that are stable, companies that have a dividend, companies that have cash on hand, companies that have a long-term track record of success. For instance, I think oil is going to continue going. I think it's probably going to go to 100 based upon my long-term experience in oil. You know, it's sort of been dead for the last 5 years, but I have a sizable position in Exxon, in Chevron, Devon Energy, Fang, which is the oil Fang, not the alphabet Fang. And then I've have banks. I have some of the recovery stocks like Freeport McMoran. I have Union Pacific. I have AbbVie Drug. So I don't have any of the growth stocks from last year. I did add a couple of them on in the after hours on Friday. I bought a little bit of PayPal. When I say a little bit, I mean 1/10 of what I would normally buy. Instead of buying 100 shares, I bought 10 shares of those, for instance. I bought a little bit of PayPal. I bought a little bit of Restoration Hardware. I bought a little bit of Williams Sonoma. I did buy a very tiny amount of Shopify. And from that point, I haven't done any more. But I do have a big short position. My short position is my biggest single position on the market itself, on the NASDAQ. So that when you ask me what I've been doing, that's what I've been doing. And I have a lot of cash waiting for certain stocks to hit certain metrics. One of the things I'd suggest is to make sure you have a shopping list. And on your shopping list, you have a buy point and have a reason for buying it there. Just don't say, well, it's down 40%, so therefore I want to buy it. You have to have more of a reason than saying that it's down 40%. Stocks that are down 40% can become stocks that are down 70% very quickly. So that's really what I've been doing, is to try to get ready and make sure that I have enough cash on hand to go bargain hunting.
One of the questions that I've thought about when I think about valuing stocks, and you were mentioning that you had a lot of the oil stocks and the bank stocks, and I've been kind of shying away from them for one reason, is that when the market seems to price stuff in, they seem to be pricing in stuff for the future. So, like, let's say that the crude oil right now is say $82 a barrel. Is the oil right now priced for $82 a barrel, or is it priced already for $100 a barrel because that's what they're anticipating it will run to? Same thing with the banks. Are they pricing right now for a 1.7% interest rate or 7.4% interest rate that we're currently sitting at? Or are pricing in like 5 rate hikes and the end of easy money and interest rate going up over like 2.5%? Are the banks pricing in all of that news already? And that's what makes me a little bit gun shy about going into those stocks, is they're pricing in, I guess for most of us would be a lot of bad news, but for those particular stocks would be a lot of good news. And I get a little bit concerned about that.
Yeah, well, that's a good thing to be concerned about. I actually bought these about anywhere from 8 to 12 weeks ago, these particular stocks.
Mm-hmm.
So I've had a nice run. And I probably have already gone through maybe 75% of the run. So you could say, well, maybe I should trim some. And I may trim some, but I haven't decided to trim yet. But I think what you're saying, there's truth in both of those comments. On the other hand, if you look historically at these companies, especially the oil companies like Exxon, I mean, they have about a 5% dividend, and that maintains these companies. And there's a lot of loyalty to these companies when the stock price is rising. Also, you know that these companies have a lot of cash, and they've become better managed over the last 5 years. They have new leadership in these companies, and they can make, they're profitable above about $30 a barrel. So right now they're making lots of money, and the oil producing countries, the Middle East countries, don't want to pump out more oil right now. They want to keep it where it is, and they're hoping that the shortage even accelerates. I think the U.S. has done a poor job to really reverse the price of oil also by releasing the strategic reserves. Did not do much. In fact, it did little to change the price of oil, just releasing those strategic reserves.
Right. And I just I feel like, so some of these smaller companies which had been struggling a little bit, if as the price of oil goes up, they're going to want to actually produce more oil themselves, because they did kind of have a pretty rough year go of it last year. So I imagine they're trying to dig out of a hole, and they want to produce more oil. And you also mentioned that you were shorting the market with, I'm guessing, the S triple Qs,
Correct.
the triple leverage. And I noticed that it had a reverse split. It had been trading for about $35, or excuse me, about $5 or $6 a share, and all of a sudden now it's $40 a share. It did a 1-for-5 reverse split. Did you buy it before the split, or did you have it after the split? And what happened? Has it gone up for you? What's
Yeah, I bought it after the split. And when the market started really correcting hard, that's when I bought it. So yeah, and it's done well for me. It's up about 20% from where I bought it.
And for the
And
viewers, kind of explain what S triple Q is, like why it how it works.
what it does is basically it looks at the future prices of stocks that comprised are in the triple Q, which are companies like Apple, like Microsoft, like Nvidia, like AMD, and it looks at basically betting on future prices. Basically, what it's doing, it's leveraging it by saying we really believe these stocks are going down, so that it moves double or triple the speed of any stock that's in there. That's a regular stock like an Nvidia, but it can move in both directions, and can lose a lot of money quickly too. So so it's a bet. It's a true bet on where things are going.
And it's a triple leverage bet. In theory, if the market moves, if the Nasdaq goes down 1%, that stock should move up 3% if it's working
Correct.
correctly. Is that
That's
right?
correct. It can go in either direction.
And if the market goes up, that stock will move down 3%.
That's correct. So
Now,
it's a bet that can either make you a lot or you lose you a lot. The thing that you have to be very careful with this can change quickly. If you're going to do this, you should be watching it carefully all day. You can't go on a vacation and just say it'll be okay when I come back from my vacation. That is what this kind of stock is for: somebody who's active in the market, who is willing to watch it, and who's willing to go in and out. During the meltdown when the pandemic started, I had a cousin of this stock, which moved up 10x in 6 weeks. And then it moved dramatically to the downside, eventually going broke and became delisted within 3 months.
wow. They're
So
giving away too much money.
Yeah, and so you have to be very careful, and you can't be greedy. If you make a very quick, uh, anywhere from 10 to 20%, um, you either should sell it outright or you should sell a portion of it because it can move quickly. If you look at the 1 year chart of this particular stock, you can see that in a 1 year chart,
What
it's
what
been,
stock is it? So I can bring it up.
what's that?
What stock is it? I
The
can bring it
triple
up.
S, the triple SQ.
Oh, S triple Qs. Gotcha.
Yeah. If you look at it over a 1 year period, you'll see that it has been trending down the entire year. It's had very few up parts. One of the reasons I'm fairly reasonably assured that I can invest in this is because of the trend of going down. It's been going down for a long time. And then all of a sudden, starting in late December, it started reversing that trend. Uh, Usually the reversals don't last a long time. They last usually at the most about 8 weeks
Mm-hmm.
before they start dropping again. If you look at all the peaks during the last 12 months, you'll notice that um, it makes a new high. It lasts for just weeks, and then eventually it begins to degrade as the market starts moving up. So we've had a tremendous bull market, right? In this last year, the S&P is what, up about 30%. Well, the S triple Q has fallen almost the equivalent amount. It started off the year with this new split price in the 80s and is now down to the 40s. So it's basically has recovered maybe half of that, but it's still down. If you look at it over a 2 year chart, you'll see that it was in March 2020, it was $733 at the high. It went there from 412. So it went from 412 to 733 during the peak of the pandemic appearing in March. And then since March, it has trended down the whole way from March 2020. It's continued to go down all the way down. Now, if you go to a 5 year chart on it, you'll see that 5 years ago, based upon this post-split price, it was $4,646 a share. So you can see, look, the graph of it, a 5 year tells you this has been a bad bet, except in these really volatile periods of time. The 2018 crash, mini crash in September through December, it hit a high of about $2,000 per share. And then the next time it has a peak is in May 2019, when it hits about 1,000. And then the next peak is at the beginning of the pandemic in March 2020, when it was at 733. And so it's dropped from that to where it is now. So, it's been a pretty healthy drop, 733 to the current price of, it closed out Friday after market at $42. It was up another percent after hours. On Friday, it was up 8.24%. And then it ended the after hour session at $42.30.
This is interesting. So I'm looking at the S&P 500 here, and from April of 19 to the pandemic low of March of 20, S&P was down 21%. When I look at the same thing here on this triple Q, when I look from May of 19 until the pandemic low of March of 20, S triple Q, the short was also down 34%, even though the NASDAQ was likely way up during that same period. How do you explain that if this thing is working the way it should, shouldn't that price, if it's a reverse, if it's the opposite of the NASDAQ, shouldn't it move when the market has gone up? Shouldn't it be moving down? And when it goes down, it should move up, right? But
Yeah,
why
it
would it, at
should.
its lowest low, why would it Let me just see if I got this right. In May of 19 to the low there, it was down. The Nasdaq was down 13%. So why would, if the Nasdaq is down 13% and that's supposed to be a reverse of the Nasdaq, a leveraged triple reverse, why would it be also down 34% when the Nasdaq was down 13%? That's
Okay,
odd to
well,
me.
what happens with this is that if you really go into it, you'll see that what it's doing basically is it's investing in option type derivatives for the future. And so that's where the discrepancy comes, because the options are not weighted the same way an S&P 500 is weighted. So it's almost comparing apples and oranges in terms of their directions and the rationale why it should be a certain way. And that's why you can make a lot of money quickly, or you can lose a lot of money quicker in both directions relative to the S&P 500.
Yeah, so the one I was trying to short, if I was actually going to short some, I was looking at shorting the VIX, because you can see you can kind of predict that when the VIX is way down these days, right around 15, 16,
Yep.
that you can, that it's going to quickly spike up. And when it spikes up, you can see these are really pointy. It comes right back down. Like right now, it's spiking straight up. So this might not be the worst time to open up a short position on the VIX. And that would be a way that I would sometimes play this, like this UVXY. It's the same exact company as the S triple Q, the Pro Shares
Right.
Ultra.
Right.
And you could buy this VIX. It looks like the VIX is kind of spiking right now. I wouldn't expect, I mean, certainly if it gets up over 31, the next direction you'd expect it to go in is down. So buying that UVXY wouldn't be the worst idea. The problem is that with these leveraged stocks, I'm having the same problem with some of these that I had with S triple Q, in the sense that when it goes bad, it goes bad really fast, and when it should be
Does.
doing good, it doesn't go good very fast. And so
Right.
I haven't had the best of luck. You know, if it works against me, I will get that triple leverage working against me, but I don't get that triple leverage working in my favor, it doesn't seem.
Yeah. These particular ones, the life of them, the life expectancy is very short.
I can
And
see
so,
that.
I don't expect to hold this beyond 2 more weeks.
Well, yeah, I mean, and I would be, devil's advocate. I would say that the reason this thing actually had to do a reverse split was because of the fact that when the Nasdaq goes down, it moves up a little, but when the Nasdaq goes up, it moves down a lot. So it was headed to zero. So then they
Right.
had to do a reverse split, because if they just kept up this pattern, it was going to go completely to $0.00 in probably about 6 months.
Right. Well, that was the problem with the triple X, which was called TVIX back then, that ended up becoming delisted because it rose from $30 to $1,000 in that 6 to 8 week period starting in March 2020. And so then it started to decay just as fast as it went up, and didn't stop decaying as the market was recovering.
Well, let's go ahead and move on about, like, so now we've got this market correction going on, and this is a very interesting article here about how to prepare for a market correction. And one of the things, the number one things, is this, put the market correction in context. History suggests that stock market is more likely to end the day higher than lower. Since 2010, for example, S&P 500 has posted gains of about 55% of trading days. Still, an especially bad day or a prolonged period of declines can cause more or little investor anxiety. When I look here, where did I pick this up? In Yardini Research, it was talking about numbers of corrections that we've had of like 56% would have been, gosh, that would have been during 2008. We had a 16% correction in 2009, and so on, a whole series of them. I guess the market corrects about 10%. I had this written here. The market corrects 10% or more about 5% or worse about 95% of the years. 10% or worse, 63% of the years, 20% or worse, 26% of the years, 30% or worse, 10% of the years. I wonder if I show this, can you see that? Or is it?
Yeah.
Yeah. So I was kind of surprised that 10% of the years you get a 30% correction, but also just letting people know, just kind of keep it in perspective, that 10% or worse actually happens most years, 63% of the time.
Yeah.
And
And,
so
and, and that chart will show you also that it can be worse than what you think. Look at the 2020 correction, which was down 30% in March, 34% in
yeah,
March.
yeah,
And then there was another one that hit of 9.6% in later 2020.
right.
So you can see, however, the just from the graph that the up time has nice long periods of time. So like 2012 to 2015, basically it was up the whole time. And then you go from mid 2015 to 2018, up most of that time, hardly any correction.
And here we are bouncing. Look at the way it bounces off this 200-day. So here's the
Yeah,
200-day moving average, and it just bounces off here, and then it bounce, dips below, bounce. And right now, curiously enough, the reason I bring this up is I'm like looking at it, we're bouncing right off this 200-day again. So we
right.
would expect, I mean, according to, I guess it could go either way, but if it holds true to form, like at least a lot of the time here, it could have a good bounce coming up here this week. And of course, it's the S&P 500, and I guess the top 5 stocks in the S&P 500 make up 23% of the weighting. The top 10 stocks make up 31% of the weighting, and I think the top 40 stocks make up something like 50% of the weighting. So we're talking about a very small basket of stocks controlling a very large portion of this S&P 500. So it seems like we've had there's been kind of like an ongoing correction since like February of last year. And I can almost describe it as like, let's say that you're building a street over something, and underneath the street, there's a big hole. And so if something breaks in the top of the street, you're not just going to fall below the street. You're going to fall another, say, 10 feet down, however deep that hole is. And that's kind of what I feel like is going on right now, that those stocks that have been holding this thing up, now they're correcting, and we're falling into this hole. So we could have a lot more pain to go. I don't really know. I just go ahead and just buy on the way down. But I do a lot of the things that were advised here in this article. But I guess one of the things it says here is put this market correction in context. And what we just kind of demonstrated is that market corrections are not a bug of the stock market. It's actually a feature, not a flaw. That this happens all the time. It's like, if you can't handle volatility, then maybe the stock market probably isn't the place, because the stock market is actually just an inherently volatile enterprise. I mean, it goes up and it goes down. It is volatile.
Yeah, and one of the things that if you dissect the market crashes, you'll note that the high growers, fast growers, the ones that are looking into the future, are the ones that decline the most. And they decline usually twice as much as household names. If you look at a Procter and Gamble versus an NVIDIA type, you'll see that they both drop, but the NVIDIA type will drop far more. That doesn't mean that even the Procter and Gamble type can't drop more. When I looked at some of the historical drops, the drops that occur, the corrections that occurred in 1987, that occurred several times during the 1990s, the dot-com of 2000, the correction of 2008, 2009, the correction with the pandemic 2020. You'll see, if you look at Dow stocks, you'll see that a handful of those had 50 to 60% corrections, and that the recovery time on most of those is at the least 6 months, and some 3 to 5 years before they reach the price at which they dropped from. So that's important for investors to know. I mean, in the 2000.com bubble, using Microsoft as an example, which is a great company, it took 15 years for it to hit back the the peak price it had in 2000. So it was a long wait to get back to that price that it had in 2000. So that also can happen.
Yeah, I'm sitting here looking at the number of days we've been in this crash here. We've only been in it for about 19 days. I was just kind of interested because I looked at this here and it was like a days of peak to trough for past corrections. It looks like we had a 16% decline in July of 2010, which took 70 days. It's like our corrections are fast and furious right now.
Yeah.
We had a 19% correction in like 6 months, and we had a 13% correction that took 100 days, and then there's a 10% correction. This was in February of 18. I thought that correction was for whatever reason in December of and again in 18. I guess 18 was just a really bad year.
Yeah, 18 was a tough time.
Yeah, so almost maybe we're headed for something like that at 18 again. So we had January to February at 13 days. It took a 10% peak to trough, and September to December of 18, 20%. That took 3 months, and then of course the big collapse in March of 2020 took 33 days. So we're sitting here. Let me just see what type of, so from peak to trough, we're 19 days and we're only sitting, it was at 8.31%. So we haven't even really had the correction hasn't kind of gotten to even this 10% yet. So I guess historically speaking, this isn't a particularly tough fall right now, at least not for the S&P. It is for the NASDAQ, certainly is for the NASDAQ. The NASDAQ's really taken a beating. I would say the peak was in November 19th, and peak to trough now is about 14.25%. So that's a legitimate correction right there.
Right. That graph you showed, Mike, of all the corrections going back, that one that you had up just before this one, that actually had the graph.
Oh yeah, Yardini.
Yeah, Yardini one. I believe that the current correction that's touched and gone, it's actually below the 200-day. It's just below it.
Yeah.
I think it's going to mirror the correction of 2020 because the pandemic is so unusual. It's not the normal correction. It's not the norm. This doesn't even come anything close to all the corrections before, because the cause for it happened 100 years ago in the Spanish flu. So, and then the rise after the correction, in later 2020 and up until through 21 was so rapid. The ascent, if you look there, just eyeballing it, is better than any of the others along that total graph.
And another reason why I have a lot of optimism about this current market is this decline that we see here, like you said, was because of the pandemic. This decline was because of a banking collapse.
Right.
We don't really have that sort of thing right now where there's a fundamental, underlying problem with all the banks we just don't have that catalyst, that market catalyst, that thing that is going, I believe, to drive it down the 56% or the 33%. I think we're probably more in this 2018 situation where it could go down 20% or 10%, but I don't foresee one of these huge, certainly nothing like this, going on right now at this second based on our current economic conditions. You got interest rates that are still giving you a negative real yield. If your bond's only paying 1.74%, and that bond rate just won't go up. People will just, no matter how much they keep on lifting interest rates, people are buying it up faster than ever. And if the bond yield's only going up like 1.74% and inflation 7%, then you've got a negative real yield of like 5%. There's no reason to flee to bonds. Now, it doesn't mean that you can't just sit there with your money on the sideline and do nothing with it. I mean, that's what I think a lot of people are doing right now. A lot of banks, they have a lot of money and they're just not spending it. Apparently.
Yeah, the banks are really in very good shape compared to the past.
Yeah.
And they should make money as interest rates rise. The difference, as I see it, Mike, is that the supply chain disruption, some of the world situation as it relates to the pandemic, uh, lack of vaccinations in multiple countries, that the recovery is going to take longer. And along the way, as if we don't have any more variants, if we don't have anything geopolitical that drives us down. I mean, if Russia invades Ukraine, or something happens with North Korea, they could easily add another leg down for the market. And it could be short term, it could be longer. But I think without any of those happening, I think another further correction of 5 to 10% would not be unusual at all.
Yeah, I'm sitting there looking at you were talking about supply chains, and it made me think about this U.S. retail sales chart. I mean, this could have something to do with it. If you look at the demand that we're putting on all of these like say rail and trucks and ships and what have you, if you look at the demand that we're doing, we've put on so much demand historically. Like this thing is like it went like this and then all of a sudden just up in a straight line. It's starting to curve down now. Retail sales are coming back down. That's why I'd be really interested in seeing what I have a feeling a lot of the retail stocks when they report earnings this time could be in a little bit of hot water, meaning that their last quarter will probably be just fine, but their forecasts are going to be pretty weak. And the reason why I expect that is because retail sales, I expect to come back to normal. I would expect that if you drew a straight line here, just like this thing always seems to be in a straight line, it's pretty linear. It will probably dip back down to about right here. And then with the lower retail sales, I would expect that our supply chain problems might come back to normal as well. We won't have supply chain problems.
Yeah, I agree with you. I think it's going to take longer than people have projected, though. If you just look at what's happening with the whole shipment of goods from Asia, you'll see that there's some problems right now that are going to exacerbate this. For instance, in China, there's lots of places that are totally locked down because of the pandemic, 100% lockdown. And that's going to slow production out of China. There's some of the major cities have total shutdown. So that's one problem. Mm-hmm. The other problem is some of the components coming from other places are also delayed. Ford announced that they're going to shut down some of their production because they don't have the chips to take it any further. They would love to have more chips, but they now say that it's going to delay things. And the stock dropped about 15% from its recent high, 20%, just based upon that news. Mm-hmm. So I think supply chain is going to add some real weight to recovery, and assuming nothing else crazy happens with the viruses, then I think 2023 will be a good year.
Yeah, and I'm not still throwing in the towel on 2022 either. Now, this Forbes article goes on to some more things you can do to prepare for a market correction. And one of the things here is sell profitable investments. And I do remember, I actually posted a video about this. I sold my Wells Fargo when it just went up in a straight line. I mean, it had it was just unusually, just what straight up like $10 a share for me in the span of about 3 weeks. And I'm like, okay, that's weird, because they're I guess that bank is probably the most sensitive to interest rate hikes. And so I feel like they're pricing in a lot of what would be good news for them in the form of like 5 interest rate hikes, 7 interest rate hikes. And so I sold them and I unloaded Visa because I felt like, I just brought up that chart about retail sales. There's going to be some bad news coming out of this next earnings cycle with respect to retail sales. And not that they're going to be bad, they're just going to go back to normal. And so that's why I got rid of those two, but I was way up on them. So I went ahead and sold a lot of that. And then basically with that got me off a margin, and it got me to where I had a heap of cash on hand. And I also sold on my JP Morgan as well. And so that like put me in a nice position to take advantage of some of these dips. I was on margin because here, you know, historically January is supposed to be a pretty good month. And so I thought, let's go ahead and leverage and kind of run the gauntlet of January, you know, and have a good time and make all this money and then sell out in February. But it just didn't work out that way for me this year. I basically just had to pull the ejection seat a little bit soon and kind of change my plan, if you will.
Yeah,
And
I did some of the same. I had owned Ford from an average price of about 12. When it hit 25 and things started to correct them, I sold all the Ford, which I'd had for a long time. I had it for 10 months. That's a long time for me. Um, I sold Nucor, which was one of my favorites, the steel company, but
mm-hmm.
it popped from 112 to 125 like in 2 days. And I said, that's not right. And so I sold it and got out like at 119, but my average price into it was about 78. Um, and so, yeah, I've sold all those. I sold my NVIDIA, which I love as a company.
Yeah.
I sold AMD. I sold a lot of those stocks that had made me a nice return. But there is a limit. You've got to set limits on stuff. You can't be greedy. This whole story.
Right. Well, I think greed is the enemy of making money in this market.
Yeah, yeah,
um, and then the next suggestion that they had was similar to what you had already mentioned in this thing. It said focus on asset allocation. And what they mean by that is that basically they're telling that one of the things you want to do is diversify your portfolio. But that wasn't one of the things he said, but he said you may also want to focus on investing strategy of the stocks you own, opting for value stocks in lieu of growth stocks. And that kind of is what you were talking about. Remember, value stocks are companies you think are undervalued based on their profits and expenses. Growth are those targeting rapid growth by running up large corporate tabs that can make them more vulnerable during economic downtimes. And that's kind of what you're saying. And I think it goes back to old Peter Lynch, where he says, if the company that you have makes money, if you're investing in a company that makes money and the company does well over time, then the stock will do well over time. And those are probably the companies that you want to be in when in these correction times, I would imagine.
yeah. There's just a time to own value with dividend. If you're going to stay in the market, those are the only kind of companies that will not make you go broke.
Mm-hmm.
If you're willing to hold them for more than 2 weeks. But where people get really hurt is that they allow a stock to go high without taking off any profit. And when they go low, they sold. When they throw in the towel and they've lost 50% of their money, that's when they sell.
Yeah, and it sounds to me like what you were saying is that in time those good stocks will come back around for you. And I think that this last point that they make here is along the lines of what you're just saying right there, is that you got to remember your investing goals. Like, why did you get in this on the first place? Was it a casino when you first started? Like, I almost feel like a lot of us were better investors when the first day we got in the market than you are, say, a couple years in, where you're suddenly getting a lot more risk averse, and you're getting into some things that like companies you would never have heard of if it weren't for the stock market. You'd never heard of these companies, and these are the ones you're suddenly buying because you think that they're going to make you thousands of dollars in a day, and sometimes they do, and because you're no longer happy making, say, $75 in a day.
Right. Well, the other thing too, Mike, is that um, if you look at um, the number of new companies that have come on the market in the last 2 years and the SPACs and all of that stuff, and then you look at the hedge fund and the people that are running money, most of these people have never been through a major crash.
No,
They've
because a
been
lot of them
through,
got in on the bottom over in 2008, 2009. I'm finding a lot of, if you're 40 years old, you probably got in right around that time. And that's a lot of these hedge fund type managers, a lot of these market movers, they're in their 40s. And so they got in at that time.
yeah, so they don't know what it feels like and what really happens. I mean, they can look at a graph, but they don't have the actual physical connection to losing 50% on a company like Exxon in 3 months, or to have a company like say QuantumScape, which has already lost 80%, and it could go down to 90%
Zero.
loss. Yeah, it could go to zero. So there's companies like that out there that were really high flyers. I mean, that went well. Let's take Peloton, for example. There's a pandemic stock that went from, it came out on the market at about $25, $26 a share, ran up to 160 during this swing, and now it's at 27. Incredible 360-degree turn during the pandemic. And now they're shutting down production.
Allegedly, they're saying they're not now.
Yeah, well, they have a lot of inventory, and they've lowered the price of the bike. I bought the bike in March 2020 when it was rocketing up, and I had just bought it saying, hey, this is going to make some money. I was able to buy it like at 28, and I sold out at 59, and then said, gee, I sold that too early when I saw it hit 110. And as it continued to, I never got back into it because I just didn't feel like this could go on forever, because historically exercise companies don't do well.
Yeah, well, their management never got, they sold it about 110 and didn't get back into it either.
Yeah. I mean, Peloton reminds me of airlines. I have never made money in 40 years in airlines.
Yeah.
You know, you have issues with fuel, issues with regulation, issues with labor. I mean, it just never works out. So maybe it works out for some people for a few months, but overall, airlines to me have been I've never made any money in an airline.
Yeah, and they're reporting earnings this week. So I guess American reported earnings last week, but we got some more that are carriers that are going this week. But I think this is a very interesting bit of advice right here. I think this says it really is as good as it could be said when it comes to what to do during a correction. Finally, while a market sell-off could catch you by surprise, that doesn't mean you have to scramble to react. Even bear markets, defined as a decline of at least 20% from a recent high, are relatively short-lived when compared with bull markets and have clocked in at an average length of about 10 months. So in 10 months, this pain should be over. We should be right back where we were. That's why even in those cases, you can sit back and do nothing. Frederick says, remember, historically, the overall U.S. stock market has always recovered from its short and longer term market dips.
Yeah.
So just do what you've always done. Maybe sit back and do nothing is the answer. Just every couple of weeks, if what you've always done is just invest your money into the S&P 500 ETF or something, VOO or whatever it is that you're putting your money in, just continue doing what the plan, invest in good companies, try and steer away from growth and just carry on, I guess. It's just saying.
I have an example, Mike, of that real quickly, is that Exxon fell in 1987 by approximately 50%. And it was the wealthiest company in the world at that point in time. Mm-hmm. Took 1 year for it to recover to its pre-drop price. 1 year later, it was the same price. Along the way, it was paying 15% dividend. So if you would have just kept adding to your Exxon and not jumped out the window, you would have had a nice profit 1 year later. So that's a good example. Another thing that you and I've talked about is about one other company that reminds me of this, and that's Union Pacific. Mm-hmm. Yeah, I've talked a lot about Union Pacific. One of the things that most people maybe don't know about Union Pacific, besides being a railroad, that when the Union Pacific was developed in 1862 under the National Railroad Act, where the country was trying to connect up both coasts, they gave the railroads a sweet deal. They said, look, if you pay for the railroad to be developed, we will give you every other section of land along your railroad. And that meant that they would give, they actually got 1/10 of all the available of the United States was given to the railroads. 1/10 of the total given to them by giving them every other section of land, which amounted to about 6,400 acres for every mile of railroad. And when they got that acreage for every mile of railroad, They also got the oil rights. They got the mineral rights. And they also, the government threw in another kicker. They gave them what were called railroad bonds. They gave them these bonds that they could cash in later on at a high interest rate at the time. The bonds were worth $16,000.
I think we lost you there, Mike. So, Mike, we're gonna. I think looks like we lost you there. Maybe you're gonna have to like re-sign back in. But yeah, so just carrying on here. So the the railroads are they have a really nice moat, and so I think in times where we have like a market crash or a market correction, um, it's very important that you get into companies that are very difficult to compete against and that do have a large moat. And so that's what I've been doing here recently as well. I liking Lowe's, I like Microsoft, I'm liking of course Union Pacific Railroad. I'm gonna basically um, I'm going to basically get out of that as soon as I get some more money out of it. I want to be up like 1,000 before I get out of that one. So we here this week we've got earnings on the way, and one of the things I want to do is show the earnings calendar. Looks like on Monday we've got IBM, Logitech, Zions Bank, Customers Bank. I guess a lot of banks, little smaller banks that are reporting on Monday. Mondays aren't usually too big in the stock market. Got Halliburton, but Tuesday to me is where it gets a lot more interesting. Um, Tuesday we've got Microsoft reporting in the morning, or excuse me, in the after hours. We've got, which I've got a big, basically a bet on these guys. I own their shares, and so I'm selling a put against these guys. And then after what happens after they report earnings, I expect it to have a good bump up, and I'm going to sell a covered call on them, hopefully a little bit out of reach, so I can keep a little bit of money, keep these shares, and make money on my sold put. And then Canadian National, this would be another rail, but what was it? CSX didn't do particularly well. Union Pacific did do well, but CSX did not. And so I don't know about Canadian National. I think they just bought, I don't know if it was them or Canadian Pacific that just bought Kansas City Southern, but I think it might have been these guys that bought Canadian Pacific. And so I'll be kind of keeping an eye on these guys. American Express, again, that travel has been taking a beating, and retail is kind of taking. I don't know. I'd probably shy away from that one for now, even though historically it's been a very good play. Lockheed Martin is one that I think might be a really nice play. And that's probably what I'm looking at on Tuesday. I think the big ones I'm looking at are Microsoft, Canadian National, Lockheed Martin, and I'm interested in American Express, even if I'm not going to play it. I just want to see how they do. And then on Wednesday, I would expect that Boeing is going to, it's not. I wouldn't. That one scares me. Not that it won't do well, it just kind of scares me. Abbott Labs will probably do just fine because they're doing all those at home. I think Abbott Labs is doing the at-home COVID test thing. Let's see what else we got on Wednesday. Not too much there. Tesla, that's going to be a big one after close. Now we know their deliveries are good. I have a feeling this stock's going to bounce because they're going to have Teslas. I feel like I see a lot more of those on the street than I ever have. It's like sometimes you can learn something just by driving around or like going out in the world, and Tesla is basically. I've seen them everywhere now. They're actually more. I feel like I see more of those now than I do Toyota Camrys. So Tesla is one that I think is going to have a really nice earnings. Plus, I think that they gave like some sort of snapshot into what you might report based on the deliveries that they've already had a pre-release of some of their delivery numbers, and they were quite impressive. Lending Club. Last time I played earnings on Lending Club, I made a lot of money. I might go to the well and do that again. That's like a $21 stock that always seems to go up. Check out what they do over earnings. Every time they report earnings, that stock bounces like 20 or 30%. So I get in there, I play the earnings on these guys, and then I play the earnings on these guys, and then I put a 1% trailing stop on them when I'm all done. Um, and so I might do a little bit of that again. Las Vegas Sands, I think it's funny because Las Vegas Sands doesn't have any Las Vegas properties, but they are one of the only casino operators in Macau. And I think that China only allowed 6 licenses, and these guys are one of them. So they're called Las Vegas Sands, but they might as well be called Macau Sands because they're essentially a Chinese company at this time. And so and it's a limited number of licenses that they're giving out. So that would be one to keep an eye on. I'm not personally interested in getting into that one. And then for the same reasons that I'm scared of American Express, I'm scared of MasterCard, I'm scared of the retail sale decline. Nucor, I think, could do well. Now, this might be a one that I would play as well. I know I'm going to end up playing more than just Microsoft this week. I just don't know which ones yet. I want to see what the setup is like going in. If something that I think is really good is absolutely just tanking going into earnings, and I really like them, and I think this is a stock that I wouldn't mind owning, I'll generally speaking go ahead and buy that stock. And of course, we got the airlines. And then Tractor Supply is one that I'm super interested in because I am a Lowe's shareholder. And so based on these guys could move Lowe's and Home Depot based on what we're finding from Tractor Supply. So this is one I'm going to pay attention to, though not playing these earnings because I have no idea what they're going to say. Apple, of course, is reporting on Thursday after close. That's always going to be a big one. They always have impressive numbers, but again, retail sales are going to. I'm not touching this with a 10-foot pole. Robinhood, Visa, I already sold. I'm expecting that could be problematic, but don't really know. And then finally on Friday, we have Chevron, which I expect to be great. Caterpillar, which I expect to be great. And this might be one I actually play. Phillips 66, which I think will be great. And so those are the ones that I'm really interested in at this time. So there you go. So that's going to be it for this week. If you got anything out of this video, if you'd like to follow, go ahead and like and subscribe. Hit that little notification bell. Maybe Money Train Mike, next time we get in, we'll get a bet. He had a power outage at his house and the whole thing went down. I guess it's cold up there in Idaho. So yeah, go ahead and like and subscribe. Hit that little bell. And until then, we'll see you next time. Bye.